Okay, so we are now live from our kitchen. No, I'm just kidding.
That's exactly right, Arena.
The
From
new
our COVID kitchens.
exactly the new way that we do business. So today we're going to be going through this deal valuation tool with Jeff. He's going to show us all the ins and outs. And essentially, I'm going to ask questions to try and make sure that if it's something that you're watching and trying to get a sense of, hopefully I'll be that observer asking questions. So Jeff, I'll let you kick it
Cool.
off. Why don't you tell us, what it is and how it's useful in the process?
Sure, exactly. I mean, where we reference this in the course was, you've already found a company, you're evaluating the company, and now you're trying to figure out, what should I pay for it, and how am I going to structure the deal? And so you're at that stage in the process. So you already have an income statement, you already have a current balance sheet of the company. And now you have to figure out, how am I going to get this thing done? And that's what this tool does. So, Rena, if you just go over to the full screen, I'll show you the tool.
Perfect. Here we go. Now the screen shows your screen, basically.
All right, perfect.
We're looking at the tool. It looks like an Excel spreadsheet.
It is. This is an Excel spreadsheet. And by the way, this is ready for your download, on the page that you're on. And you can use this for all your deals. I mean, it does a lot of calculating. This is a tool that is built over a fair amount of time, and it's been used many times, and so it works really well.
Okay.
So here's where we are. All the yellow cells, and you see a bunch of them there, need to be filled in. So that's where you put in your inputs. All right. And then once we get through the inputs, here's all your outputs right here, which right now is blank because we have no inputs. But we'll get there, and I'll show you exactly how this works.
Okay.
So you just start at the top. And what you want is to get an idea what the revenues of this business were and what the operating earnings or the EBITDA for the business has been over the last 12 months. Okay. So let's just assume for a second we've got a business that's doing $2.5 million in revenue and 10% margin, so they're making $250,000. Okay. Now a note here. You notice this note here. So let me explain that. On most income statements that you're going to see, you're going to have revenues, you're going to have the cost of goods or cost of sales, and below that you have a gross profit. Below that, you have selling, general, and administrative expenses, better known as SG&A. And once you subtract out your regular operating expenses, you have operating income. You basically have how much money this business actually generated in income before interest, before all your taxes, before depreciation and amortization, and really before any unusual items. So for instance, let's say the business owner of the business you're buying has a country club membership, $25,000 a year. Well, on his income statement, that's going to be an expense, right? So maybe this business only earned $225,000 in operating income, but once you buy it, I mean, you're not going to be paying $25,000 anymore for a country club. So what you're trying to get to here is, on a go-forward basis, how much does this business actually generate in cash?
Okay, got it.
That make sense?
I mean, it's all a little bit over my head at this point, but at the same time, I understand because I'm a business owner, and that is essentially what we're all trying to figure out. But in this case, you're saying that before expenses, right? Before any of the business tallies, that's what the number we want. And then we want the one that is just pure profit.
Yeah, I mean, the other way to calculate is what precisely as it said here. You can always take your pre-tax income and work up. So you add back the interest, you add depreciation, amortization, and any non-recurring items. It's the same thing that I just discussed. So basically, what's your operating income? That's what you want to know.
Operating income, got it.
Right. Below that, Now you start getting into the balance sheet. So this is all you need from the income statement right here. That's it. Okay, easy. Balance sheet. How much cash is on the balance sheet today?
Mm-hmm.
All right, let's say it's $100,000. Now, some sellers will want to take all of that $100,000 home. They see it as their cash. And so when you buy the business, it has no cash. And that's okay. I'll deal with that in a second.
Okay.
Or in other cases, they'll say, look, I'll leave the cash. Just give me credit on the purchase price for the $100,000. Either way, you come out to the same numbers. So I'm going to assume that this seller is going to take all the cash away. And I'll show you how to put it back on.
Okay.
All right. Accounts receivable. Now, the next 4 items here, accounts receivable, inventory, fixed assets, and real estate,
Mm-hmm.
I want those because you can borrow money off of your accounts receivable. You can borrow money off of your inventory, off the real estate. And we need to know what assets does the business have on which you can borrow some money. Because again, we're trying to borrow every dime of this transaction, right?
Mm-hmm.
That's the idea. No cash down. So let's say the receivables in this case is $500,000, and your inventory.
Accounts receivables. Most businesses, they do the work and then they invoice, right? Or some
That's
businesses
right.
now
Yeah, that's
invoice
right.
and then
So,
do the work.
So let's take our book business. Okay, we sell books to a university bookstore. All right, they'll pay us generally 60 days later. Okay, that's accounts receivable. We've sent out $500,000 of the books. We haven't been paid yet. We will get paid, but we haven't been paid yet.
Okay.
All right, and you can borrow money on that $500,000 that you have not even been paid yet.
Okay, that makes sense.
Okay, the inventory. All right, just using the book distribution business as as an example. Let's say you have $250,000 worth of inventory. Well, you can borrow money off of that.
Right? So those are basically the books on the shelves that are ready to be sold?
Yeah, those are the books sitting on the shelves.
Okay.
Let's say it's 250. Or if you're in a machine shop and you're buying a machine shop, I mean, there are parts. There's work in process. There's you've bought all of your stuff to make whatever it is your business makes.
Makes sense.
And you've got $250,000 worth of it. Okay. Fixed assets. Now, these days, it's harder to borrow money on fixed assets than it used to be. All right. So what's a fixed asset? A fixed asset would be, let's say you lease a place and you've invested $100,000 in leasehold improvements. That's a fixed asset. You have bought some equipment. That would be a fixed asset. You have cars that you've acquired, for your business, or trucks for delivery. Those are all fixed assets. And so what you want here is really the real value of those assets today. So if you bought your truck for $40,000 and now it has 200,000 miles on it, it's not worth $40,000. It may be worth $5,000. So that's the number you want down here. What are the assets really worth? Okay. For simplicity, I'm just going to say we're not going to borrow off of fixed assets. Real estate. If you can buy real estate as part of a transaction, most of the time, that's a good thing to do. And it's a good thing to do for a couple of reasons. One is you can borrow against it. And the second is if you want to use SBA or the Small Business Administration financing through a bank, SBA loan, the SBA loves real estate. They will bend over backwards for a real estate loan where they might not even touch your company without it.
Interesting.
So you like real estate. So in this case, I'm going to assume that we've got $250,000 worth of real estate.
But when you first purchased the business, you told me that there was no real estate, that they were renting the space, right?
Oh, when we bought our business, yes, that's right. In our case, we did buy the real estate, but we bought it as a second part of the transaction. The reason for that was it took us longer to get the SBA loan in place than it did the loan to buy the business.
So in this case, if they were renting the property, it would be still zero for the real estate?
That's right. If you're renting it, it's just a big zero.
Okay.
Right? But just so I can show you how you can borrow money off of it.
Yeah.
I'll put in 250. Wrong place.
Yeah.
Put in 250,000.
Okay.
So those are the basic items from the balance sheet. So what else do we need? Debt being assumed at closing. So what in the world is this? Let's say you're buying a business that has delivery trucks. All right. And when the business bought the truck from GM, GM financed it. Not unusual.
Okay.
All right. Or maybe they have an existing bank line with some money borrowed on it. Or existing company credit cards with money borrowed on it. You really have two alternatives when doing a transaction like this. You can demand that at closing, all of that debt gets paid off by the seller. And you don't assume anything. But if it's cars, trucks, stuff like that, normally it just makes sense just to assume the debt. Does that make sense? All right. And if you assume the debt, then you just have to do some research and say, okay, at what interest rate is it? It's at 5%. It's at 8%. It's at whatever. How many years are left on the note? If it's a car note, maybe on average you only have 3 years left. Right? And and you're assuming $25,000 for the car. All right. And you just put those numbers in. Okay. In this case, again, for simplicity, I'm just going to assume that you're not assuming any debt. So no debt.
So, okay, got it. So again, if they had something at the business, such as, trucks and merchandise and everything that was not paid off, was debt basically, right?
Yeah, exactly. Okay. Yeah, I mean, it's just a liability that you're willing to assume. And either in the asset purchase agreement or in the stock purchase agreement, depending on which way you go with that. I mean, there'll be verbiage in there, very specifically stating you are assuming those loans. All right. So, everybody knows. All right. Going down here, are you going to be investing any money in the deal?
Okay, that's interesting. Right.
Right now, I'm just going to say no. Nope, not investing any money.
Well, did you when you bought the book business? No.
No, we did not invest a dime.
Cool.
Okay. Now let's come down here.
Let's say you bought the business, like, I don't know, just for an example, and there did need to be like renovations, then that's where you would put the number here, right?
That's right. So as we go through this, you'll see what the end result is, at the bottom of the spreadsheet. And in some cases, you're going to need more capital.
Right.
All right. And if you need more capital, this is probably where it is. So you just change this to yes. And you say, okay, we're going to invest $100,000, $50,000, $20,000, I mean, whatever it is.
Right.
All right. Okay. And the spreadsheet will do the rest for you.
I like it.
Okay. So we're going to say no and no. A couple other data points, and then we can see how this ends up. What percent earnings growth, EBITDA growth, would you like to assume? Okay, so in the next 5 years, this model is going to take you out 5 years at a fixed growth rate every year, 5%, 10%, whatever.
Okay.
I really caution you not to do anything above 10%.
Okay.
All right. And the reason for that isn't that I'm trying to be conservative. The reason for that is once you compound 30% a year for 5 years, you come up with some pretty darn big numbers.
Mm.
All right. Probably not realistic. Might be. And if it is, fantastic. You're going to work out great. But if it's not, so let's say I'm really confident about this business. We can grow at 10% a year.
And again, these are evaluations. This is not like you actually know, right? Because even like when you were buying the business with COVID and everything, like you evaluated it before COVID.
Right.
Did you go back through and did you end up changing the numbers, or did it matter at that point because you were already in the process?
Yeah, it's a great question. And in the book business that we bought, it really didn't matter.
Okay.
Because there were so many things that we knew could be done in this business that an actual growth rate, frankly, wouldn't make sense unless you started with the second year. In the first year, we're going to make all these changes.
Mm-hmm.
And then after that, we're going to grow it at 5 or 10% a year.
Makes sense.
Make sense?
Mm-hmm.
Okay. So I'm going to assume 10%. What percentage of the company are you acquiring? Okay. Most of the time, it's going to be 100%. I'm buying all of it.
Right. And what if you have a partner, as in your case? Like, do you still put 100% for this?
Yeah, you still put it. Great question. Yes, you still put in 100% because all you're trying to do is figure out how to buy it. You'll figure out later who has what in this 100%.
Okay, right? Got it. So like this, it wouldn't be 100% if you were, for example, buying a partnership in the business, right? Versus completely buying the business.
That's right. So for and this spreadsheet really assumes you're going to have a majority ownership. The spreadsheet will give you an idea if you are, buying a smaller piece of it. But really, to get the valuation right, normally I just put in 100% anyway, and then figure out, okay, I'm going to buy 80% of the business, but I want to know what 100% of the business is worth.
Okay, so 100%.
Yep. Okay, next 3 questions here are about expenses. Don't get me wrong, there are expenses in the transaction, and some of those expenses you're going to have to fund up front, even if you get paid back at closing. So in our case, between my partner and I, we put out probably $30,000. I mean, not an insignificant amount.
Yes, and then you got it back. Was it?
Oh, we got it all back. That's right.
Was it money that you had set aside, or did you even end up borrowing that money?
No, I didn't borrow that money. That's money that either Kevin or I could write a check for, but we got it all back.
And again, if you didn't, right, like let's say because the course is no money down. So what can you do in that case if you do need that small seed money to be able to do the transaction that you then get back? What do you do in that case?
You find a partner who's willing to put it up.
Gotcha. There you go. You heard it from the man.
Look, I mean, presumably you could put it on your credit card.
Right. Okay.
But most people, and again, we were doing a $30 million revenue transaction.
So yeah, you wanted to make sure.
So $30,000 is a lot of money for a smaller transaction. But anyway, I mean, if you don't have the cash, if you can't borrow the cash, then you find somebody who will come alongside you and help you out.
Perfect.
All right. So first expense that you're going to have, I guarantee you, is going to be legal expense. Somebody has to figure out how to paper this transaction, how to write the contracts, and that's going to cost money. In a typical transaction, okay, this could be as much as $50,000, $75,000. In our case, we had a lot of complications in getting our deal done because of COVID. So there are a lot of things that had to be redone multiple times, and we spent $100,000.
Oh wow!
And that's just on our side of the table. The other side of the table spent a bunch of money too.
Wow!
Right? And again, it was all paid at closing, not out of our pocket. We borrowed the money to pay the lawyers, so they got paid fully at closing. But here, I'm just going to assume $50,000. Take one of those zeros out of there.
So in this case, when you're putting in these numbers, you're doing your best evaluation, right? You're thinking ahead, you're trying to figure it out. But if you're off, that's still okay, or how does that work?
Well, you're not going to be able to estimate anything exactly. So, you just do the best that you can, and realize if all of a sudden, you get into something complicated, and this number is going to be higher, you can go back to the spreadsheet, put in the higher number, and just see what the impact is. But but basically, if you can make this deal work with the numbers you put in here, it's unlikely anything is going to change dramatically enough where it's not going to work. So
makes sense.
You should be okay. All right. Question. How much additional working capital do you want to add to the balance sheet? So what in the world does that mean? Remember, we went up here and there's $100,000 of cash on the balance sheet. But we said the owner is going to take all of that away. So the question is, you've got to add more cash to the balance sheet. You can't operate a business with zero cash.
No, yeah. Okay.
Right? So how much cash? Let's assume, just for the purposes of this, that you want to put that $100,000 back.
Okay.
So at closing, you'll have $100,000 in cash in the bank. So it's $100,000. Now, this sometimes is the favorite question when I do this presentation.
How
much cash
do you want to get at closing?
Right.
Right?
Yeah, you mean I can pay myself? Are you serious? Wait a second, I can do a transaction with no cash.
And pay myself.
At the table, I walk away with a check that I deposit. That's exactly right.
Right. That's why people are here taking the course, right? They want to be able, first, they want to, of course, buy a great business. But secondly, they also want to be able to pay themselves, like we talked about in the course, for the time, work, effort spent while buying the business.
That's right. And the beauty of this is not only do you get paid here, but you'll become an employee of the company and you'll get your normal salary, whatever that is for you. And I mean, all of a sudden, I mean, and realize, we talked about this versus starting up starting from zero.
Yes, tough.
Right? Starting from zero, you don't have money to pay yourself. You don't have money to pay a salary. You don't have money to do anything.
Tough road. I mean,
it is, isn't it?
Counting my blessings for getting through that. That was tough, guys. So what we're showing here today, I know maybe your head is spinning because honestly, my head at certain points in time is spinning, but I know what it's like to start a business from scratch.
Yep.
That will really get you to spin. And you actually end up needing a lot more capital too, because you need to sustain yourself, number one. And if you're going all in and you don't have a job, then you're working off your savings that you're never going to get back. You need to invest the time, and even before you bring on a team, right, you need to be able to have a ton of hours to dedicate. I mean, my first few years, I was definitely putting in some crazy hours, and I just thought that was the game, right? I didn't know about
what you have to do.
I didn't know about this, right? I didn't know.
In this case, Irina, I'm going to pay you $50,000. How's that?
I like it. You know what I mean? I need it.
Well, then you better go buy a business.
I'm ready.
Okay. Now, you remember back up here, we were talking about inventory, receivables, real estate. So this is where we get into that.
Okay.
So how much money can we borrow on our receivables? Generally, it's in the 80% range. So if you have $100 in receivables, generally a bank will lend you $80. Okay?
Okay.
Sometimes it'll be lower. It might be $70. And the deal I just did, actually signed it yesterday. I agreed to 70%. But, ours is, we're selling to university bookstores in the middle of a pandemic.
Right.
So, I had to take a little haircut.
Right.
Inventory. This used to be 50 to 60%, but in today's lending environment, it's now closer to 40%.
Okay, good to know.
All right. Fixed assets, again, in our case, we didn't have any. And real estate, generally, you can borrow 80% loan to value. And one very important thing here on the real estate, I'm going back up here. Notice what it says, real estate appraised value.
So you need to get it appraised.
Yeah.
Okay.
You do. So it doesn't matter. I mean, if you had bought, if the owner originally bought this real estate for $100,000,
doesn't matter because you're looking
doesn't matter because he's not going to sell it to you for $100,000.
Right.
You're going to sell it at appraised value, and off of that appraisal, you can generally get 80%.
Okay.
All right. So, last couple things, then we'll get to the good part. Interest on your receivables and inventory loan. 11% sounds like a very big number in today's zero interest rate environment, right?
Right.
But frankly, for small businesses, again, if you're buying a $100 million business, this would be a different number. It'd be a lot lower. But in buying a small business like this one that has $2.5 million in revenue and $250,000 in earnings, this is about right. This is about what you should expect. So about 11%.
Okay.
On the real estate, you've got a couple of options. You could go SBA and borrow 80, 90% maybe on the real estate. And here's the term. How many years are you paying this off? Well, if it's the SBA, 25. And if the SBA, I just did an SBA loan, 5.25%.
A little better.
Yeah. All right. So I'm just going to assume that we're going to take the time to do an SBA loan here. And
is it more time consuming? Is that what it is when you do a loan? Or
yeah, I mean, there's a government agency involved, so there's some time. I mean, everybody takes their time. I mean, the amount of documents that it takes to get one of those deals closed is amazing. It's a full employment act for lawyers, but you can get it done. You can get it done. At the end of the day, that's what you want. Okay. All right. Down here, if you were going to do some cash flow lending, so let's say you wanted to borrow, you weren't going to borrow off the assets here. You were going to borrow off of the $250,000 in cash flow. Well, the first thing I would tell you is that it's too small of a deal to be able to do a cash flow loan. So in this case, I'm not going to talk a lot about this. Most smaller businesses, you can't get a cash flow loan, so forget about it. Okay. So I'm just going to put in no and just jump down here.
Okay, and I have a kind of a silly question, but like when you're buying a business, right, and it's a small business, you keep saying small business. Small businesses, what like range are we talking about when you're saying small business? Well,
to get to a cash flow loan, you probably need $2 million. Excuse me, $2 million in operating earnings.
Okay, so that's what we're
at $250,000.
Okay, got it.
All right, most deals, if you're going to do it without cash, most deals you're going to need some more money. So where do you get the money? You get the money from the seller.
What?
Yep. If the seller wants to sell his business, and let's say he takes back a loan, and I've assumed here it's a 5-year note, a 5% interest rate, that's not a bad deal. That's not a bad deal for him at all. In fact, it helps him on his taxes or her taxes, because now that part of it is an installment sale. So they'll pay, their taxes on the sale over time for that portion of it, which is the seller note. But also, generally, a seller note is going to be secured. And what's it going to be secured by? All the assets you just bought. So if you default, the seller can take back the business.
What?
Sure.
Okay.
All right. Don't default.
Right.
Okay. All right. So that's a longer conversation there. But let's assume for a second, 5 years, 5%, and they agree to that.
Okay.
Okay. We come down here, and I've got 3 alternatives for us.
Oh, wow. Look at that. Very cool.
All right. And so what is this? So we start off with what is the multiple for the deal price? So in other words, for the entire enterprise, forgetting real estate for a second, forgetting debt, what's the business worth? And if we say it's worth 2 times, then it's worth $500,000. 2.5 times, 625. 3 times, 750. And again, for most small deals, this is the range to work in. Now, if you've played with publicly traded companies, they may sell for 8, 10, 15 times EBITDA or operating earnings. You're not buying a publicly traded company.
Right.
These are small private companies that we're talking about.
Okay, got it.
All right. Now, if by the way, you can adjust these if you want. If I want to put a 3 in there, boom. Look, we got 3, 3.5, and 4 now. Okay. I'm paying 750, 875, or $1 million. And so in this spreadsheet, we're going to go through 3 different alternatives based on different pricing. Okay? So we take the enterprise value, which is basically the value of the business. We add the value of the real estate. If we were assuming any cash, which we're not, we'd subtract that out. If we're getting any cash at closing from the seller, we'd have to add that back, or he just takes it out.
Right.
Right. So at the end of the day, the equity value, what the business owner is going to get for everything, 750, 875, or $1 million. Oh, how are we going to finance this thing? All right, the receivables in the inventory is going to be $700,000. Okay. Oh, that also includes, by the way, the real estate loan. Sorry.
Okay.
We're not doing any cash flow loans. You're not investing equity. So if I've got, and then let me finish this thought. So the seller is going to have to take back a note for $250,000, and you're saying, wait a second. If I'm buying the business for $750, I'm borrowing $700. There's only $50 left. How come the note's got to be $250?
Yeah.
Because you have $50,000 in transaction expenses.
You're
putting $100,000 in cash on the balance sheet, and you're paying yourself $50,000.
I see.
All right. So at the end of this, look, you've raised $750,000 after all of your expenses. You've paid $750,000 for the business, and the business owner has gotten $500,000 in cash at closing. Now, if you paid it $875, you still have the same numbers are still working here, except the seller note has gone up by that additional $125,000. He's still getting $500 at closing, and now a bigger seller note. And look, I mean, the seller might come back and say, heck no, I'm not taking. Well, let's say it 3 times. We're saying he's going to have a $500,000 seller note on $1 million purchase. And he's saying 50% of this purchase price, you want me to carry in a note? Heck no. So, this is thing to be negotiated and, just to be considered as you're going through this. Okay. So by the end of this, we financed the deal on 3 different purchase prices.
Can you just really quickly review what the seller note means again? Just because
sure.
That was very important, and that's the main criteria that changed regarding the different alternatives.
Right. So what we said, if up here is the seller note would be for 5 years.
I see.
At 5%.
Okay, got it. Now I understand.
Okay, so a $250,000 note. You're going to spend $50,000 a year paying that off, plus interest, which would be $12,500 for the first year, and then it goes down every year after that because the balance goes down. All right. Remember, the business is making $250,000. So you are using 50 of your 250 to pay the seller note. You're, in essence, using the cash flow of the business to pay the seller over time.
I like it.
It's a beautiful thing.
That makes a lot more sense.
All right. I'll explain all this here in a second, but I want you to go down to the last row of the spreadsheet.
Year number 1, payment coverage.
In the first year of this note, or excuse me, of this transaction, we're assuming you're going to be earning that 250 plus your growth rate, which was 10%, so $275,000. But out of that 275, you have to pay interest on your receivables and inventory. You have to pay interest and principal on your real estate loan. You have to pay interest and principal for the seller note.
This is where the strings are attached.
Yeah, well, that's right.
All right.
Yeah, I mean, you've got a fair amount of interest cost here, right? But the good news is you've got excess cash. So this first number here literally tells you how much excess cash you have. At the end of the year, if you started with your bank account with $100,000 that you put right here, at the end of the year, you should have $197,630 after you've paid your principals, after you've paid your interest, after you've paid federal income tax, because this spreadsheet also calculates that.
I love that. And this is after you've paid yourself, right?
That's right. Whatever salary you've put in there, assuming was part of that, the earnings or the expense.
What did you put in this case? What did you put? 50,000 or what was it?
No, you can. We didn't really talk about how much you could earn, annually in the business. That really is business dependent. If the old owner, if you're going to take over for the old owner, and the old owner is taking $100,000 salary, then you can take $100,000 salary, and the numbers don't change.
I understand.
You're not paying him now; you're paying you.
Right.
So,
okay, got it.
Right. So this is important because obviously you want that to be a positive number. you don't want to have more cash going out than coming in. So that's good.
This is
the question is
primary reasons why you do this, to basically see if it's a good deal and if it's worth your time.
That's right. But you can also see how much you can pay for the business and make it work. And that's why this last row is so important. If I can get back to it here.
There we go.
All right. So the payment coverage I want is 1.5 to 1. Okay. So what does that mean? What it means is that you have cash flow of $1.50 for every dollar of interest and principal expense going out the door in that first year. Let me say that again. Yeah. If you have $1 of principal and interest payments, we want you to make sure you have $1.50 in earnings.
Yes, so that
you have 50 cents left over. Right? Okay, so why do I say 1.5 times? You want a cushion. In business, not everything goes right. I don't know if you've noticed that.
Oh.
Right? Not everything goes right. Yeah. And so if you get into the business and you're expecting $275,000 in earnings and you get $200,000, oops.
Oh, yeah.
You need a cushion.
You sure do.
Because your principal and interest expenses aren't going to go down just because your earnings. So you have to have a cushion. And so generally, if you have a 50% cushion, you're good. All right. So let's look at these numbers. This one is a 1.84. Plenty of room at the lowest purchase price. That's a 750 price. At the 875 price, you're right there. You're right at 1.5. You're good.
You're good.
This one, not so much.
No, that you're below the cushion that you were talking about.
Right. So if we go back up here, what are you going to pay for the business? And you're going to pay somewhere in that range.
Yes, and you don't want to pay more than 3 times because that is not showing what you're looking for. Okay, got it.
You don't have the cash cushion. Right. And so given that we're at 1.49, I mean, really you can't go above 875.
Okay.
Now,
So
you could start the negotiations down at 750, and they could come back at $1 million, and a little back and forth, you end up at 875, and you're good.
and you're good. Okay.
All right. And you will have bought a business for zero cash down. You will put $50,000 in your pocket at closing. Here it is right there. That's yours.
That's insane.
All right.
That's
You will have your $100,000 a year salary or whatever it is, and you'll have a 50% cushion on all your payments. And so at the end of the first year, you would expect to have $67,000 more in your bank account. At the end of the second year, add another 90,000.
This is in the bank of the business, or literally?
Yeah. This is excess cash flow. You could pay this out to yourself every year. Remember, we started this one with $100,000 in cash.
Yes.
So at the end of year one, it's 167. You don't need 167. You can pay that to yourself.
Gotcha. But you're
add 90. Why do you add more the second year than you do the first year? Well, you're growing the business at 10% a year. That's just the way the numbers work.
Mm-hmm.
All right. And so by the end here, you're generating almost $200,000 a year. And cumulatively, if you add all that up, that is $711,488. So let me ask you this. If you were to turn around and sell this business after 5 years, what would you take home? All right. And I'm going to assume that you're going to sell it for the same 2.5 times multiple that you bought it for. Now, I don't know about you, but if I bought a business for 2.5 times, I'd like to sell it for 4 times. Something more than 2.5. But I'm just going to assume for this.
It sounds like a dream. Like,
well, look, you're using the cash of the business, the cash flow of the business to pay off your debt, or some of your debt. Mm-hmm. You're using the cash flow of the business to grow cash on your balance sheet. Mm-hmm. Right?
Yeah.
So 3 times, or 2.5 times rather, the 5th year earnings is $1 million. Now, at the end of 5 years, you still have $660,000 in debt. So what's that comprised of? That is the inventory debt. That's the receivables debt, which again, you don't pay off until you sell the company.
Right.
Right. You're just paying interest on that. It's called a revolving loan. All right. Okay. You still have your real estate. I'm just going to assume 5 years later, the real estate's still just worth $250. Probably is worth more.
Probably will go up. Yeah.
Yeah. Probably worth more. And you've got $700,000 in cash. So in total, if you sold the business at the end of year 5 at 2.5 times, you should be able to put in your pocket before you pay your taxes $1.3 million.
What?
Now, Irina, how much did we invest in this company?
$30,000.
Well, $30,000 to get here, but you got that 30 back.
Right.
So how much did you really invest in this company?
Zero. You guys.
Zero.
You got the money back.
Right.
You got paid.
You invested zero, and 5 years later, you have $1.3 million.
You got paid for the transaction. You got
5 years of salary.
You got 5 years salary, like a decent human being that deserves a salary for making the changes that are necessary to the business, right, growing it. And so, and you're now a multi-million-dollar business owner. So that automatically raises any other transactions that you do, right? I'm sure it will reflect positively. I
guarantee you. You do this type of transaction, you walk away with 1.3 before taxes. After 5 years, you will find a second and a third one.
Yeah.
And you will do it again. And they're probably going to be bigger businesses. Again, this is a nice small business. It's got 10% margins, $2.5 million in revenue. Nothing wrong with the business at all.
And this is after 5 years. And that's basically how long it's taken me to build a reputation in my market. It took me about 4 years before those people that I really wanted to talk to started actually listening to what I had to say. Before that, it was just, really hard to get somebody to listen to you. So with this, after you've completed this is exactly how long it would take you to just reach where you're actually able to pay yourself a salary, like a decent salary.
Right.
In this case, it's way better because I'm still not.
You've done that from day one.
Yeah, I'm still not in the millions. I'm getting closer. But I just understand that it sounds like a lot, and it sounds like a lot of responsibility, but on the other hand, so is starting a business from scratch, if not more responsibility. So there's some keywords here that you'll have to understand. We're going to be able to have these chats with, Jeff, to make sure that you're on the same page, that you understand. We're going to have, a glossary of terms for you
Yeah.
that you're going to download in the beginning of the course. So basically, it's kind of like learning another language, and it's doable, especially when you have someone like Jeff by your side, really walking you through every single transaction and making sure that you're understanding what's happening. So the first time is the hardest. Once
Sure.
you do it, right, it's going to get easier. And so I just can't believe that this is possible. I mean, my mind is still.
Well, all right. So let's ask the question. What's the catch?
That's a great question.
I mean,
Yeah.
it's unbelievable, right? I mean, you
Right.
start off with zero, you end up with 1.3 million in 5 years.
Right. Okay.
Now, I've got to be doing. There's got to be some sleight of hand here somewhere, right?
Well, the only thing so far that I've noticed is that you do need to have some capital to put in, because you're going to get it back. But so far, that's the only catch that I saw.
Well, that's right.
The
I
heading
mean,
of
again, if you're going to hire a lawyer, if you're going to hire the firm that's going to do your inventory financing, they're going to require what they call a good faith deposit. It might be 5,000 or 10,000. And yeah, I mean, so there are some expenses, but you get all that back at closing. All right. So here's the gotcha. You ready?
Ready.
How did I do that deal? The one I just outlined. I did it because it had a lot of receivables.
Mm-hmm.
It had good inventory, and it had real estate. Now, let's say I've got the same exact deal in the staffing business. All right. I have no receivables, or very small receivables. There's no inventory in staffing. I've got people.
Not so
right. And generally, there's not real estate. You're in a leased office. The only assets that a staffing business has are desks, chairs, and computers, all of which are worth virtually zero.
Yeah.
So in that deal, you can't do it completely without cash. The cash has got to come from somewhere. Even if you got the SBA to agree to do, the loan, they're going to require 10 to 20% of the entire transaction in cash from you. So every company is not going to fit into that mold that would allow you to do it. But I will tell you, every company can be evaluated precisely the same way I just did that valuation for you. And you will know within 15, 20 minutes of plugging in some numbers what can be done and what cannot be done.
Yeah, and this today is closer to 50 minutes because we had to stop and explain, and Jeff had to answer my questions. But typically this wouldn't take that long because you would just be plugging in the numbers.
Oh, no, it's you can plug in, if you have all the numbers ready, you can plug them in 10 minutes and look at the results. Right. It's really very quick.
And then you know exactly what number, like you were mentioning, to be able to say, okay, like this is what I'm putting in, and then they come back with a counter offer, and you know that you're really trying to get to that other number, right? So right. The middle is where you're thinking it's going to start, but you can start with the lower number and then kind of work your way back towards the middle number because you still want that 1.5.
That's right. And look, for the business I just showed you, if at the end of the day, you won't pay more than $875,000 and they won't sell it for less than $2 million, you don't have a deal.
Right. Yeah. Just
go on, find another one, because you're not going to get that done unless you want to write a big check.
Yes. And right now, do you think with we're just entering post-COVID, it's not even really over right here. We're at the end of 2020. What are you thinking about buying a business during this time or in the next year? Is this a better time? Is it a worse time? What do you think?
I'd say I think there's going to be more businesses available for sale because of COVID than any time in my lifetime.
In history.
I completed this transaction in the middle of COVID. We completed it in June. COVID started in March. Mm-hmm. And frankly, it caused us a lot of problems with a couple of lenders, but we finally got it done. And, and we bought a business that's selling to college, university bookstores, all of which were closed. So how stupid are we to buy a business in the middle of all that, right?
Right.
So, look, I mean, if you just go to Main Street, wherever you are, walk down, the strip shopping center, half of those businesses are about to go out of business. And if you can come in and use seller notes, use an earn-out structure, which we'll talk about separately, and and borrow a little bit of cash, there's lots of deals that can get done here.
So now you know how to do a valuation on a deal, and you probably learned a lot of new exciting terms today. So we're going to go ahead and just pause this here so that we can have a separate video for that, and we'll jump right back in for the rest of the course. So thanks so much for watching.
Thanks, guys. Go out and find a good business.
Yes, go out and make sure you do you download the Excel spreadsheet and use it.
Yep.
Awesome. Thanks so much, Jeff. This was super helpful.
Got it. Bye.